point, I think I could give you a lot of reasons why you should be skeptical on equities, and we can talk about the risk-reward ratio not being that rosy for long-term investors. But the anchoring of the low interest rates, to me, seems to be the main driver of what we observe in equity markets today. So the very low interest rates, not only in bonds trading in Europe or the treasury curve, is also filtering into credit rates. And that very low discount rate means that investors are bidding up long duration assets. And within the equity market alone, which is by itself a long duration asset, but the longest duration asset you can get is growth stocks. And that is why you see technology stocks really being bid up in value to the valuation levels that we are seeing. So if the central banks are continuing down this path, and if we get yield curve control down the road, I'm absolutely sure that it will continue to prop up valuations for growth stocks. It will create an even larger divergence in the equity market, a larger concentration among technology stocks to the rest, and value stocks will continue to underperform. It's very unprecedented, but I think it's the main driver, and that's also why you're seeing gold and growth stocks actually having a pretty high correlation in the past couple of months, because they're responding to the same input from the central banks. So although I can give you a lot of reasons, valuations are quite high, etc., I think that if we continue with this monetary policy, it's a go on equities, and it will be fueled by the technology growth stocks.
So one of the stories we're reporting on this morning, I guess, is one that everybody in the market understands at a professional level, and it's the reweighting, the rebalancing that the pension funds and institutional money managers may have to go through as we come to quarter end here, and it's been a very strong performance for equity markets. The investment banks have been tripping over themselves to outbid each other on the size of this rebalancing. I think Goldman Sachs suggested $76 billion worth of money will find its way into perhaps fixed income or other investments as a way of reweighting away from equities. How big a deal is this story actually? And do you think much of that reweighting will already have been done?
I think these types of topics are extremely difficult to quantify and isolate. So my view tends to be that a lot of these pension funds and very large institutional investors that are doing these rebalancings, they're definitely not stupid. They know exactly how they rebalance that portfolios without causing price impact, and they also look at the market, and they don't do it in a few days. So I think this is a continuing rebalancing of that portfolio. So I don't think the immediate effect in a very short time period is that significant. It's not something that we really look at as a major factor that in our investment decisions or in our views, to say the least.